Reinsurance is essentially insurance for insurance companies. Just as individuals or businesses buy insurance to protect against financial loss, insurance companies themselves need protection from large claims that could threaten their financial stability. This is where reinsurance comes in. It allows an insurer, known as the ceding company, to transfer part of its risk to another insurer, called the reinsurer. The primary goal of reinsurance is risk distribution. By spreading out risks, insurers can take on larger policies without fear of going bankrupt if a major disaster strikes. This ensures solvency, meaning that insurance companies remain financially healthy even after paying significant claims. Additionally, reinsurance stabilizes underwriting results by protecting against unexpected fluctuations in claims. For instance, consider a small insurance company that underwrites policies for homes in a coastal region. If a hurricane causes widespread damage, the claims could be overwhelming. Without reinsurance, the company might struggle to pay all policyholders. But with reinsurance, a portion of these losses is shared with the reinsurer, ensuring the company remains financially viable.